Hello guys, this is Ali Solanki and today in this video we'll be talking about how to plan your finances, especially if you're a teenager or even if you're in your 20s. But before I begin with this video, I want you guys to comment whether or not you have started your investment journey and where have you invested your money. I remember when I was 18 years old and just started my investment journey, I didn't have any proper source of income. It was just the money I had saved from pocket money or saving money on travel and so on. And it becomes really difficult to have a proper investment or financial plan when you're earning like this. So in this particular video, I will be telling you exactly how you can invest this amount instead of letting it sit in your bank account and how you can start your investment journey early on in your life. So let's talk about the most hyped up thing and the most misunderstood topic, which is debt or loans. We are always taught from a very young age that debt is always a bad thing and you should never take loans. But let me tell you, that's not always the case. If you take loans or credit card debts for buying something fancy and something that will just lose value over time, like cars or phones, only then I would strongly advise you to stay away from it. This is called bad debt. However, taking loans for buying a house which will generate rental income for you or starting out your new business venture that you're really passionate about is something that is classified as good debt. This is because you are investing your capital in things that will generate more money than what you had put in the first place. It will appreciate or grow in value over time. So make sure you understand this major difference between good debt and bad debt right at the start of your financial journey. When you start to earn money, you will realize that most of it will go away in taxes unless you're smart with it and know how to legally reduce the tax burden. And that's where you will realize the importance of taking loans instead of paying everything upfront. Now let's actually move a step further, and before I start talking about where to invest and make proper financial decisions, let me first talk to you about why you need to start investing and give a strong reason to keep at it. So when I was a kid, I was always told to study till my 10th grade and then my life will be set. After that, it was study till your 12th exam, and then came the entrance test, and then study till your graduation, and then people would tell you to work hard till you turn 60 so that you can finally retire and actually have some fun. This is just the cycle almost everyone gets dragged into, mainly because of a lack of financial knowledge. The goal I was talking about is called the FIRE movement. It stands for Financial Independence Retire Early. And as the name suggests, the goal here is to break the cycle and retire at a very early age of 30s or 40s. But the main question here remains, how do you do that? In order to retire at such an early age, you need to make sure that the money you're earning doesn't depend on your time. What I mean by this is you need to earn money even when you sleep, or let money make more money for you. The best way to do that is through investments alone. Say you have a salaried job. The day you lose your job, you will not have a source of income at all. However, while you're earning your salary, say you kept around 20 to 50% of it for investments. This will in turn generate a new source of income for you, which will compound over time and you won't have to depend on your job anymore. This is in short how you can retire and do the things that you actually like, and you don't have to wait to turn to 60 for that. Here, one more question that might pop up in your mind is, how will I able to generate enough revenue through investments alone? For that, let's understand it through an example. Say your yearly salary is around 5 lakh rupees or around 40,000 rupees per month. If you don't want to depend on this job and earn through investments alone, you would need to get a return of at least 5 lakh rupees per year. The stock market historically has given a yearly return of around 12 to 15%. So if you would have invested 30 lakh rupees in the stock market, you could easily get a yearly return of around 5 lakh rupees from it. So you basically need to save around 30 lakh rupees in order to be financially independent and leave your job and do the things that you actually like doing. If we assume that you are saving just 50% of your income for investments every year, that means you can achieve this goal in 12 years time. Now I have purposefully not accounted for inflation here because your salary will also keep on increasing over time and you will be able to save more for investments. So as you can see, it's quite possible to lead a retirement life quite early on, but the main takeaway for it is that you need to start your investment journey as soon as possible. And for that, I would highly recommend you to go over and make a demat account for yourself and start your investment journey. If you don't know how to exactly set up your account, you can check this particular video that I had made on opening your demat account with Grow app. Now you can use any stock market app for your choice, but the process will more or less remain the same. But there is a small catch in this particular calculation. It is that I have not included for emergencies that you might face in the future. For that, I would highly recommend you to take an insurance for your family and yourself. I personally am not a big fan of life insurance, but I would highly recommend you to go for health insurance at least. If you're in your early 20s, you can easily get health insurance with a cover of over 10 lakh rupees, which you can get after paying a premium of around 6 to 7,000 per year. Now that we've talked about why and how to invest, let's also look at where should you invest this money. Traditionally, people used to invest a lot in real estate, gold, or even fixed deposits. But to invest in real estate, you need a lot of money, which might not be available with you at the moment. As far as gold is concerned, it is quite a volatile asset and doesn't have high returns either. However, you would notice that gold prices tend to increase whenever there is a stock market crash, and that's why you should invest in gold, but not more than 5% of your portfolio. After this, as you're quite young and don't have a lot of financial responsibilities, you should put a major chunk of your portfolio through mutual funds. Ideally, keep 50% of your portfolio in mutual funds, especially index funds like Sensex and Nifty. These index funds basically track the top 30 or 50 companies of India. I have personally invested in HDFC Sensex Index Fund, but you can choose any of the top funds. They give almost the same returns. After this, you can invest 30% directly in stocks. These can be further divided into stocks of large, well-established companies and smaller companies that have a huge growth potential. Other than this, you can have 10% of your portfolio invested in the foreign markets, either through buying direct stocks of companies like Apple, Tesla, etc., or by buying index funds that track Nasdaq. Now, for the last 5% of your portfolio, you should invest in volatile assets like cryptocurrencies. Now, because I am a developer and work in the crypto field, I have almost 50 to 60% of my portfolio invested in cryptocurrencies. But of course, I would not recommend this to someone who's just starting out their journey in the investment world. I will soon be making a detailed video of my investment portfolio, so do let me know in the comment section below if you would like to see it. So that's it for this video, and if you like this video, then you might also like this particular video that I had made on the top financial apps that I particularly use. So do give it a watch.